Muni bonds are coming off 3 negative straight months for the first time since 2016 as investors are a little wary of the news out of Washington. My next guest says the key thing for muni investors to watch is the inclusion of that 15% minimum corporate tax rate in the latest packages. Joining me now is Michael Zezas, head of U.S. Public Policy Research at Morgan Stanley. Michael, great to have you back. Why is that tax rate so relevant?
Well, it's important because if you get banks and insurance companies, which are about 24% of the muni market, if their muni holdings start to become partially taxable in some way, which in theory could happen here with this book tax, which we think probably would, unless it's specified by Congress to not include municipal income, then what you have is a market where the individual investor really becomes the primary and almost only investor interested in munis at this level. That lack of diversity in the market isn't particularly helpful. It makes the market less structurally sound. So it's a situation where it could be a problem, even though muni credit health, by and large, is very, very strong right now.
Well, I just heard that, there could be muni apes. Look what they've done for AMC. Maybe an individual investor shareholder base isn't that bad. But one more time, connect the dots for me. So you're saying a 15% minimum corporate tax means banks and insurance companies may sell muni bond portfolios because they don't want to pay tax on the profits?
So right now, if you're a bank or insurance company, if you own a muni bond, you're being shielded from basically your effective tax rate. But the muni income counts towards your total income. And so if you end up not paying enough tax such that you fall under this new minimum tax, the income you're earning from munis therefore becomes partially taxable. So that doesn't necessarily mean you're going to sell your bank portfolio, your muni bank portfolio, but you might not want to add any more munis at current levels, which are pricing relatively rich to taxable bonds because you're not enjoying that tax benefit anymore. And that would mean that the flow of the market, the demand flow of the market would be largely based on individual investors.
Yeah, that's really interesting. I never would have connected those dots, so I appreciate you pointing this out. Let me just ask, if they have to sell for basically not fundamentally economic reason. In other words, they have to sell because they don't want to pay taxes. Does that create a dislocation that individual investors should buy because they wouldn't otherwise get that yield opportunity or something like that?
Well, so it creates a vulnerability in the sense that you're taking one sort of solid demand base and you're weakening it. That vulnerability probably expresses itself over time in the market becoming more volatile because it's more concentrated in the individual investor. And when you see, for example, outflow cycles, which is when individual investors are pulling money out of mutual funds, it creates volatility, which has nothing to do with credit quality. So the short answer to your question is that volatility and that excess spread, yes, that does become an opportunity for any investor, really, but probably the individual investor who's willing to own the asset despite the volatility.
And you're saying it also kind of undermine the performance, maybe, or the sort of steadiness that they might be looking for, depending. Really interesting. Michael, we appreciate you joining us today to explain it. Well, obviously, I'll be watching to see what happens next with those bills.